So with the US election on the horizon, I think it's important today to take a look into how the potential outcome of that election could impact our investments. If Trump and the Republicans win, is that good or is it bad for the stock market? If Biden and the Democrats win, how is this going to impact our money? In this video, we're going to be taking a look into how the result of the election could impact our investments. We'll be looking at past elections as a gauge on what could happen, and we'll answer a very interesting question. Which party is generally considered most bullish for the stock market? Stay tuned, because I think you're actually going to be surprised by some of the results. So before we get into it, I want to make it clear that I'm not a financial advisor and this is not financial advice. I really am just a regular guy researching this stuff to try to get my own head around things, as it's quite confusing out there, and then I'm just sharing that research with you. I'm also not going to get political in this video either, which is really quite difficult as I'm talking about the election, but my focus is on how politics impacts the market. To be honest, when it comes to politics itself, honestly, I don't think I actually know enough to really add value to the conversation anyway. Okay, so let's jump straight into it. And in fact, you know what? Let's just kick it off with maybe the most contentious point of all. Which party is better for the stock market? The Democrats or the Republicans? I'm going to run you through some specific pros and cons for each party, and then we'll look at the data and see if the data actually backs up these points. So if there is a Republican victory, there is likely to be continued deregulation of certain industries, such as fossil fuels, financial services, healthcare, and big tech. Obviously, with less regulation, that's bullish for those industries. Stock buybacks are also likely to remain high, which is of course bullish for the overall market. However, there could be a more confrontational approach towards US-China relations. And while I do think that both parties are going to take quite a tough stance, I think it's unlikely that Biden will be maybe quite as confrontational as Trump has been in the past. And we've seen how easily US-China relations can spook the stock market. So maybe a more confrontational approach could be seen as a negative for the market. On the flip side, a Democrat win will likely lead to more economic stimulus, and more money being pumped into the economy and feeding its way into the stock market is, well, it's obviously good for the price of stocks. However, the counterbalance to this is that the Democrats will likely introduce higher taxes on businesses. If businesses pay more in tax, they should make less money, and in theory, they should be worth less. With a Democrat win, if there is re-regulation of those industries I mentioned before, fossil fuels, financial services, etc., that could be seen as a negative for those markets. Also, if they limit stock buybacks, it could hinder companies from borrowing cheap money and, in many cases, artificially inflating their share prices. And while this is something I think needs to change long term, it could damage stock prices in the short term. So, the truth is that both parties, they have their pros and their cons when it comes to looking at how each might affect the stock market. And you know, I'll tell you the truth. I was naive before researching this myself. And if you put a gun to my head and asked me which party I think is better just for the stock market prices, again, nothing political, just for the value of stocks, I would have probably said that the Democrats wanting to spend more money on the economy is very bullish. But maybe this will be outweighed by things like higher taxes on businesses and the other elements they're trying to bring in. In other words, I probably would have guessed that a Republican win would lead to the highest stock market out of the two options. I think I'm maybe not the only one who would say this either. Like I say, both parties have their positives and negatives, but one association that I keep on seeing in the news, rightly or wrongly, is the link between a Republican win and a stronger stock market. So let's look at the data and let's see if there is actually any truth to that historically. Well, looking at this image, we can see that the stock market has trended higher and higher regardless of which party is in power. As we can see, the overall trend since the early 1930s has clearly been upwards, but much more remarkably though, there really isn't much difference whatsoever between the two parties. In fact, dating back to 1933, a Democratic president typically presides over a higher US equity market than a Republican president. However, if you strip away some outliers, such as the boom years under President Bill Clinton or the dips prompted by the dot-com bust, there's practically zero difference in the equity market returns. And I think this final sentence really summarizes it for us. There is a perception that party affiliations of presidents are going to impact stock market returns much more than has actually played out in the numbers. So while we have our preconceived notions about which party might be more positive for the stock market, the data has historically shown that it doesn't really matter which party gets elected from an investing standpoint. But having said that, it's not just about who becomes president, as there are 3 potential scenarios here, and each of them could have a different outcome. So the first scenario is the status quo, where President Donald Trump is re-elected and Congress remains split between Republican and Democratic leadership. An argument can be made that the market would like this, as it would at least know where it is. We know that markets generally like certainty. Well, things staying as they are is pretty much the path of most certainty. The second scenario is the Democratic presidential nominee Joe Biden wins and there is a Democratic sweep of Congress. According to Stephanie Link, chief investment strategist at Hightower, if this happens, the market will probably sell off, maybe at 2 to 4% based on the tax proposals. However, the virus will make it very difficult for Biden to hike taxes on companies. So unless there is a vaccine, those levies will likely be deferred. As a result, she believes that the market might sell off initially, but the best approach is to buy the dip. The third and final scenario would be if Biden wins and Congress stays split between Republican and Democratic control. I think that the market likes that the best because probably not much gets done. Therefore, I think equities will rally. Now, I don't know about you, but all of those outcomes sound surprisingly optimistic. I mean, intuitively, when you have 3 potential scenarios, you feel like one of them must be much more negative than the others. However, as we've already seen, it turns out that which party is elected, well, historically, it hasn't made much difference. And on top of that, you'd probably be surprised to hear that the market has been positive overall in 19 of the last 23 election years, from 1928 to 2016, only showing negative returns on 4 occasions. So this further backs up the idea that the election and the fears surrounding it are usually either unfounded or exaggerated. But at the same time, that doesn't mean we are in for a smooth path. It doesn't mean we won't have volatility. And the reason that we probably will have some pretty big swings is because investors hate uncertainty. There is uncertainty about which party will be elected. Now, we know that this probably isn't going to make too much difference in the long term, but most investors do believe it will be a big difference. We have one of the most divided elections we've ever seen. I mean, watching that first debate, for example, it was truly sad to be tuning into what should have been a civil discourse, and instead, I've watched children have more constructive debates than that. Just recently, we've heard that the president has contracted the virus, so who knows how serious that's going to be. And the threat of second, third, fourth, fifth waves is still looming, and who knows when we will return to some semblance of normality. So, from my research, the big picture looks like this. We are in one of the most uncertain times we've ever experienced because of everything that's happened over the course of 2020. And for most of us, we expect that the election will throw another spanner in the works. However, what I'm seeing is that there will probably be a lot of volatility in the lead up to the election, and there may even be more in the aftermath. After all, we've already heard numerous discussions about whether the result of the election will be accepted or contested. So we don't know how that's going to play out. That's extra uncertainty piled on top of everything already so far this year. Well, I don't know about you, but it freaks me out a little bit. But what is surprisingly positive to see is that the result of the election appears, at least based on historical data, to make virtually no impact on the market. And that means that if, like me, you are a long-term investor, the election, shockingly, isn't actually that relevant to our investments. But here's what concerns me the most. When interviewed, 45% of investors surveyed said they plan to make changes before the election, and 62% indicated they will likely make changes in the 12 months after November 3rd. And we can see this playing out in the data too. So this bar chart shows us investments into 2 types of funds in the lead up to the year of the presidential election and the year after the election. Essentially, an equity fund is an investment into the stock market. So the more money flowing into equity funds, the more bullish people are on the stock market. And as we can see, the money flowing into these funds is around about $90 billion in the election year. and then climbs significantly up to approximately $160 billion in the year after the election. This tells us that people are more fearful during the election year and more confident the year after. The other type of fund here, the money market funds, are essentially investments into cash equivalents, etc. So they are considered very safe. The money flowing into them is much higher during the election year, again indicating people are nervous about the stock market. And then it drops much lower the following year, backing up the idea that investors feel confident about the market the year after the election. And remember, 19 of 23 election years have actually been positive for the stock market. So I think we are all expecting volatility in the market. I mean, I'm not going to sit here and tell you everything is going to be plain sailing. In fact, like I say, I'm expecting some big drops and some big rises. But what the data is telling us is that if we are long-term investors, we should pretty much ignore the results of the election. Now, of course, I've talked about the other factors at play in the market extensively in other videos, and I'm no less concerned about them at the moment, but it's certainly nice to see that I've probably built up my concern about the election and how it's going to impact the market much more than is actually valid. I'm keen to hear what you think though. Do you think the election will have a big long-term impact on the stock market, or do you think it's just going to increase volatility around the time of the election, as my data is kind of indicating? Let's have a conversation in the comments. And if you've enjoyed this, watch another one of my videos by clicking up here. Thank you for watching.